The Dow hitting a record high today. The S&P 500 struggling to hold gains, but coming off its best week of the year. And hedge fund sentiment looking similarly rosy, according to our next guest. Here to share how the space looks heading into year-end, Mithra Warrier joins me here at Post 9. She's Citi's North America Head of Capital Introduction. Mithra, great to see you.
Great to see you. Thank you for having me.
So it was a great first half of the year, both for the markets and generally, I think, for equity-oriented hedge funds. Are they not just kind of playing defense and trying to limp to the end of the year? Or they're looking for further upside in general?
Yeah, it's interesting. If you remember, at the end of July and early August, we had a tremendous amount of volatility. And this is really why you hire hedge funds. And hedge funds showed that both in that period of volatility in July and August, they were able to handle the volatility well and put up some positive gains. So normally, as you go into Q4, some people think that, let's take our foot off the gas, let's lock in gains. That is not happening this year. Everyone wants to, seize this momentum and lock in double-digit gains for the year.
Does that mean being positioned aggressively or just sort of looking for the chance to get more tactical?
Yeah, that doesn't mean you're just buying, right? You're looking for opportunities on the short side, especially in technology, consumer, the AI boom, right? There's just as many people thinking that it's, overbought and looking for short opportunities there. So both on the long and short side, you're seeing opportunities in the biotech industry, in the energy industry, in the commodity space. So actually, volatility brings tactical opportunities. So people are being quite tactical.
And, on paper, the market would seem to be pretty ripe for stock selection, trading one thing against another, right? Because the first half of this year, it was kind of like 7 stocks dragging the index up. Now, it seems like you have these rolling rotations and a lot of stocks actually outperforming the index. So I guess where does that bring the typical manager at this point in terms of where they think is worth playing?
Yeah, stock selection is relevant. Again, a lot of times what we would see is when a manager wants to hedge, in the last few years, we would see ETF hedging or custom baskets. And while those still are relevant, we're seeing idiosyncratic single name shorts come back to the market. So, and even on the long side, you're seeing stock selection becoming a bigger driver of returns. And that's something that I think is very positive. We track, among the managers in our universe, we track dispersion and performance returns. And in the equity long short space, dispersion is actually higher than it was last year among manager performance, which tells you that your stock picking is important and can drive your returns.
Sure.
So it's something good to see.
Interesting. Now, in terms of the end investor, what are they mainly interested right now in capturing from the hedge fund asset class?
I think they want diversification and downside protection, right? End investors tell us they don't just want somebody that's doing well when the market goes up. They can invest passively. Mm-hmm. They want hedge funds to offer downside protection, but also upside capture. So they want them to be uncorrelated to the marketplace, and that's probably the biggest request we see, that hedge funds really serve as that diversification. But you do need to be cash. You do need to generate returns. You can't just be a downside protector.
Sure. There's this line that the hedge fund industry, equity-oriented hedge funds in particular, have become so top-heavy in terms of the assets under management and the returns, like the Millenniums and the Citadels and .72s, these sort of multi-manager shops, seem like they're consuming a lot of the oxygen in the industry. Is that something that makes it more of a challenge for the end investor to figure out where to go?
I think the bigger getting bigger, but I think with this market the way it is and with stock selection becoming more relevant, there is a space for the small and emerging managers, especially in sectors. Biotech is a sector where you may not want to be with a very large manager, right? And so there's spaces and energies in other sectors. So what you're seeing is capacity-constrained sectors come back into play where there might be an opportunity to invest with a specialist manager. And that's some interest we're seeing. Again, I was in the Middle East last week in Dubai and Abu Dhabi for a few days, and their interest in equity long short hedge funds and stock selection and single strategy managers is actually quite robust. So it's a bright spot we're seeing.
Is that in general because those investors, the LPs, don't expect much in the way of aggregate market returns? They feel as if you have to be maneuvering within the market?
Actually, they have a very high hurdle for market returns, which is why they feel that managers in spaces that are maybe less trafficked or less traveled or can be nimble in their asset allocation and their stock selection will have the opportunity to outperform. They still want established track record. They still want institutional quality, but they want that double-digit returns.
Yeah.
And so they want managers who really will be aggressive on risk-taking and will be nimble and tactical.